Welcome to today's presentation. Let's take a closer look at final accounts. Final accounts are essentially the summaries of all the ledgers of a business. They are organized in a way that clearly shows the profit and loss for the specific accounting year, as well as the financial position of the business at the end of that year. When we talk about the components, you'll notice there are three main parts: the trading account, the profit and loss account, and the balance sheet. The trading account helps us understand how well the business is doing in terms of buying and selling goods. The profit and loss account then shows us the overall profit or loss after accounting for expenses and incomes. Finally, the balance sheet gives us a snapshot of what the business owns and owes at the end of the year, reflecting its financial position. These final accounts are vital because they give us a comprehensive view of the business's performance and financial health. They help stakeholders make informed decisions about the future. Throughout this presentation, we'll see how understanding these accounts is key to managing and growing a successful business. Let's talk about the concept of a receipt. A receipt is essentially any amount of money that has been received by a business. This includes money received in the past, the present, and even in the future. Now, it's important to understand that this money can come from the regular activities of the business, like sales or services, or from irregular activities, such as one-time transactions or special events. The key point here is that a receipt captures all the income the business gains, regardless of the timing or the nature of the activity. This idea ties into the overall theme of understanding how businesses record and track their income, which is fundamental for accurate financial reporting and analysis. Let's start by understanding the difference between revenue and capital receipts. Revenue receipts are amounts that the business receives as part of its regular activities. Think of things like sales, service income, or any other income earned consistently over time. These receipts are for the past, present, and future because they come from ongoing operations. A key point here is that revenue receipts do not create any non-current liabilities. They also don't liquidate any non-current assets. Essentially, they don't impact the long-term structure of the business in terms of liabilities or assets. Now, on the other hand, we have capital receipts. These are amounts received due to irregular activities, meaning they are not part of the normal course of business. Examples include proceeds from issuing shares, loans, or sale of assets like property or equipment. One important distinction is that capital receipts create non-current liabilities or liquidate non-current assets. For instance, if the business takes a loan, that creates a liability. If it sells a long-term asset, that liquidates a non-current asset. So, in summary, revenue receipts are regular, do not affect the company's long-term liabilities or assets, while capital receipts are irregular, and they do impact the company's long-term structure. Recognizing this difference helps us understand how the business manages its cash flows and financial position over time. Let's talk about the concept of payment. When we mention payment, we're referring to any amount that has been paid at any point in time, whether that's in the past, the present, or even in the future. And it's important to note that these payments can be related to both regular activities, like monthly bills or salaries, and irregular activities, such as one-off transactions or unexpected expenses. The key idea here is that payment isn't just a one-time event. It's an ongoing process that reflects the financial exchanges resulting from the business activities. Whether it's the money we've already received, the payments we are making now, or future amounts we're expected to pay, all of these are part of the overall picture of our cash flow. Understanding this helps us see how payments link directly to the core operations of a business, affecting our financial health and planning. So, in essence, payments encompass all the financial exchanges tied to our business activities, both routine and extraordinary, that shape our financial story. Let's take a closer look at the differences between payment, revenue, and capital. When we talk about revenue payments, we're referring to any amount that has been paid or received in connection with the ongoing, regular activities of the business. This includes past, present, and future payments, but importantly, these payments don't settle any non-current liabilities or create new non-current assets. In other words, revenue payments are part of the core operations, like paying suppliers or receiving income from customers. On the other hand, capital payments are a bit different. These relate to irregular activities, not the day-to-day operations but larger, less frequent transactions. Capital payments can involve amounts paid in the past, present, or future, and they typically result in the creation of non-current assets, such as property or equipment. Alternatively, they can also be used to settle non-current liabilities. So, in essence, capital payments are linked to investments or financing activities that shape the long-term structure of the business. Connecting this to our overall theme, understanding these distinctions helps us accurately classify and analyze financial transactions, ensuring we have a clear picture of how the business is generating value and managing its resources. Now, let's talk about income. Income refers to any amount that has been received or that might be receivable in the future for a specific period. Importantly, this income is generated through the regular activities of the business. Whether it's sales, revenue, or other earnings, the key idea is that income is what the business earns over a certain period, reflecting its financial performance. On the other hand, we have expenses. Expenses are any amounts that have been paid or may need to be paid in the future again for a specific period. These expenses arise from the regular activities of the business, such as paying wages, rent, or utilities. Essentially, expenses are the costs incurred to keep the business running and generate income. Connecting these points to the broader theme, understanding the distinction between income and expenses is fundamental to assessing a business's profitability. Income shows what the business earns, while expenses show what it spends. Both are crucial for evaluating financial health and making informed decisions. Now let's talk about income and expenses, which are essential for understanding a business's financial health. They can be categorized into two main types, direct and indirect. Direct income and expenses are those that are directly related to the core activities of the business. For example, in a manufacturing business, this would include the purchase of raw materials, the production process, and the sale of finished goods. These are the activities that directly generate revenue or incur costs related to the main operation. On the other hand, indirect income and expenses are all other types of income and costs that are not directly linked to the core activities. These might include things like interest income, rent, or administrative expenses. They support the business, but are not part of the primary revenue-generating activities. It's also helpful to distinguish between manufacturing and trading businesses. In manufacturing, the focus is on acquiring raw materials, converting them into finished products through production, and then selling those finished goods. Conversely, a trading business mainly involves purchasing finished goods and selling them without the manufacturing process. Understanding these distinctions helps us analyze where our income comes from and where our expenses go, giving us a clearer picture of business profitability and efficiency. Let's take a closer look at operating, indirect, and non-operating income and expenses. These categories help us understand how different financial activities impact a business. First, operating income and expenses are directly tied to the core activities of the business. This includes things like salaries paid to employees, rent for office or shop space, and other costs that are essential for running the business day-to-day. These are the expenses and income that are part of the regular operations. On the other hand, we have income and expenses that are not essential for the ongoing running of the business. These are often referred to as non-operating items. For example, if the business sells an asset at a loss or gains from the sale, that's considered non-operating income or expense. Similarly, depreciation, while a necessary accounting practice, represents the reduction in value of assets over time and is categorized separately from operating expenses. Understanding these distinctions is crucial because they help us analyze the true profitability of the core business operations versus other financial activities. This separation allows stakeholders to see how well the business is performing in its main activities, without the distortion of one-time or non-core items. So, in summary, Operating income and expenses are directly linked to the day-to-day functioning of the business, while non-operating items are more about the financial activities outside of that core scope. Recognizing these differences helps us better interpret financial statements and overall business health. Now, let's talk about profit and loss, which are fundamental concepts in business. Profit is simply the excess of income over expenses. So, if a business earns $100,000 and spends $80,000, the profit would be $20,000. It's the money left over after covering all costs. On the other hand, loss occurs when expenses exceed income. For example, if a business earns $80,000 but spends $100,000, then the loss would be $20,000. Recognizing these two concepts helps us understand a company's financial health. Profit indicates a successful operation, while loss points to areas needing improvement. These are key to evaluating how well a business is doing overall. Let's take a closer look at some key financial terms that are essential for understanding a company's profitability. First up, we have gross profit or loss. This figure reflects the revenue remaining after deducting the cost of goods sold, so it shows how efficiently a company is producing and selling its products. Next, we move to profit or loss, which considers all operating expenses. This gives us a clearer picture of the company's core profitability from its main activities, before accounting for interest and taxes. Then there's operating profit or loss. This is similar to profit, but it specifically focuses on the profit generated from regular business operations, excluding non-operational factors. Finally, we have net profit or loss. This is the bottom line, what's left after subtracting all expenses, taxes, and interest. It essentially tells us the company's overall profitability during a specific period. Understanding these different levels helps us see the full financial picture, from production efficiency to overall profitability, tying back to our broader theme of financial health and strategic decision-making. To truly understand how gross, operating, and net profit or loss are determined, and how the final accounts are prepared, you'll need to watch the next part of the presentation. It's important because these concepts form the foundation of financial analysis and decision-making in any business. By mastering this, you'll be able to interpret financial statements accurately and make informed business decisions. So, stay tuned for the continuation, where we'll dive deeper into the actual processes and calculations involved. Remember, understanding these key points is essential to grasp the overall picture of a company's financial health.